Welcome to the deep dive. So, if you look at the markets lately, wow, AI stocks, especially in that infrastructure space, they have just been on an absolute rocket ride.
Unbelievable valuation.
Exactly, unbelievable. But then you get these sudden, really sharp dips, and it makes you ask the big question, are we in an AI stock market bubble?
Well, that question,
Mm.
it really depends on who you ask and, what lens they're looking through.
Okay.
You talk to, say, stock market valuation experts, people digging into the balance sheets, they often say no.
No, really.
Their argument is that profits for the big players are actually rising just as fast as their stock prices.
Mhm.
So by those traditional metrics, they'd say the valuation is, mostly justified.
There's always a but.
There's always a but. You step back and you talk to macroeconomists, the people looking at the whole system, the whole structure.
Okay, big picture.
And from that view, they see these huge system-wide imbalances, a lot of speculative behavior, and this intense concentration of capital. And from that perspective, yes, a lot of them would argue it looks very, very much like a bubble.
And this is where we want to challenge the thinking a bit for today's deep dive. This is our aha moment.
Exactly. We've all been sort of conditioned to think bubble means bad, that it only goes with words like collapse and loss.
Of course, that's what you think of.
But if you look at history, it's pretty clear. Bubbles have actually been the driving force behind humanity's biggest technological leaps forward.
That is a fascinating way to reframe it. So we're not just here to say yes or no, it's a bubble. We're going to unpack why past bubbles collapsed, look at the specific structural problems brewing in AI today, and try to identify the critical financial triggers.
Real red flags.
The real red flags that could decide the fate of this whole investment cycle.
Let's do it.
Okay, so let's start with history. This idea that bubbles actually drive progress. Give us an example, a catastrophe that actually, ended up helping us.
The 19th century railroad bubble. It's the textbook case.
Okay.
I mean, it was an epic financial mania. And yes, millions of people lost fortunes when it all ended. But what did it leave behind?
It's infrastructure.
Permanent, modernized global transportation and distribution networks. It fundamentally changed commerce forever. The capital that was destroyed, that was temporary, but the connectivity, that was permanent.
And I guess the dot-com bubble, which, felt catastrophic for a whole generation of investors.
Oh, absolutely.
It gave us the commercial internet, the very engine that's powering this AI age we're in right now.
Exactly. And just look at AI today. Without this astronomical, almost speculative level of investment, this gold rush mentality, AI development might have just stalled out.
Stalled where?
At much simpler things, Maybe it would have just gotten really good at playing the game. Go, and that's it. It's the sheer insane amount of capital being poured into R&D right now that's forcing this rapid, comprehensive advancement. Bubbles basically pull tomorrow's technology into today.
So if the bubble is the engine, the real question is, what are the structural flaws that make it so unstable?
Right.
And historically, the biggest flaw, the one that causes the eventual correction, is overinvestment and duplication. The railroads were famous for this.
Oh, the duplication in the railroad era was.
Yeah.
It was financially absurd. You had multiple train lines built literally parallel to each other between major cities.
Like what?
The Pennsylvania Railroad competing directly with the Baltimore and Ohio Railroad, both running between New York and D.C. It was just pure waste. A chicken game to see who had the deepest pockets and could survive the longest.
And are we seeing that same kind of absurdity playing out in AI right now? Is that duplication risk really that high?
It is extremely high. And the scale is now global. We are seeing intense effort duplication, which just guarantees that an eventual consolidation is coming.
Okay, so who's duplicating what in the U.S. market?
Well, just look at the list. You have, 7 or 8 major players all chasing the exact same thing. You have OpenAI, which is backed by Microsoft.
Right.
But Microsoft is also developing its own large language model separately. That's duplication, even between partners.
And then there's everyone else.
Everyone else. You've got Meta with their Llama series. Elon Musk has Grok. Google has the mighty Gemini series. Amazon is in the game with Titan, focused more on B2B. It's an incredibly crowded field of heavyweights.
What's really interesting from our sources is that some of these giants are already hedging their bets. It's like they're admitting they know this winner-takes-all scenario is coming.
Precisely. You have Google and Amazon both making huge strategic investments in Anthropic,
The developer of Claude.
the developer of the Claude series. They know they can't all win, so they're buying an insurance policy on a key competitor. And now, of course, Apple has jumped in with Apple Intelligence. So that's 7 massive firms, all doing fundamentally the same, incredibly expensive R&D.
And you said this is a global thing.
It is. In China, you have the giants Baidu, Alibaba, Tencent, plus a dozen or more aggressive new companies. And in a place like Korea, the duplication is just fierce. We're talking massive hardware investments.
Like the chips.
The chips, never securing 60,000 of the top NVIDIA chipsets, SK Telecom getting 50,000. And other conglomerates are battling for what's left. Capital expenditure is just staggering.
That just doesn't sound sustainable. We know from history, right, especially in IT, that these markets always consolidate.
They absolutely do. IT markets almost always settle into, a duopoly or a very tight oligopoly. Just think about the operating system market for PCs or for smartphones.
Microsoft and Apple, Google and Apple.
Exactly. There's just no economic model where dozens of these competing high-cost infrastructures can all survive. The market can't support it. So a collapse phase is, well, it's inevitable. The winners will buy or bankrupt the others and take all the returns.
Okay. So if duplication is the fundamental structural cause of this reckoning, what's the variable that controls the timing? What's the trigger that actually starts the big sort out?
The signal, historically and today, is a big shift in the cost of money.
Interest rates.
A rise in interest rates. When rates go up, the cost of capital suddenly matters. A lot. And only the companies with huge cash flow and perfect balance sheets can keep funding these duplicated, highly leveraged projects. The weaker players who are surviving on cheap money, they become vulnerable almost instantly.
And that railroad bubble collapse, that gives us the most extreme example of interest rates being the trigger, doesn't it?
Oh, it was chaos. In 1845, the Bank of England raised its rate from 2.5% to 3.0%.
Just 0.5%.
Just 0.5%. And that was enough to send the first shockwave through all those leveraged companies. But they didn't stop there. They kept hiking and hiking aggressively. It hit 5.0% the next year and then peaked at a staggering 10.0% by late 1847.
10%. I mean, today, a 0.25% move sends markets into a panic. A fourfold increase in rates. That must have been total devastation for those railroad companies. Why? Why did the Bank of England have to be so violent with its own economy?
They were trapped. They were constrained by the gold standard.
Ah.
See, the railroad mania required massive imports, rails, engines, parts, and it was all being paid for in gold. This created a huge trade deficit and just accelerated the outflow of gold from the UK.
And the value of the pound was literally tied to that gold.
It was. So the Bank of England had no choice. They had to hike rates dramatically to stop the gold from leaving and protect the pound's power, even if it meant sacrificing their domestic economy.
That is such a crucial distinction. The gold standard forced their hand. But today, we're on a fiat currency system, which gives the U.S. Federal Reserve way more flexibility, way more control.
It does. And that makes this AI bubble, harder to burst on purpose.
Bubbles are always hard to burst, right? They almost always grow bigger than anyone expects.
Far bigger. But the question is still there. What modern catalyst could force the Fed's hand? We see 4 main scenarios.
Okay, scenario 1. A voluntary, drastic Fed rate hike. The Fed pulls a Bank of England and goes to 10%.
The probability of that is near zero. The Fed is acutely aware of what would happen if they popped this massive, systemically important AI bubble. They will not voluntarily raise rates aggressively enough to cause a collapse.
Okay, so on to scenario 2, a credit crunch. Maybe it starts with financial stress from, say, the polarization of the U.S. economy?
This is a very real risk. Our source material points out that while the top 20% of the U.S. economy is doing great, the bottom 80% is seeing their real income fall. Wages just aren't keeping up with inflation.
And that stress hits the banks.
It hits the regional and mid-sized banks hard. People default on loans, the value of collateral goes down, and banks get nervous. Think about what happened with Silicon Valley Bank. And that kind of fear starves AI companies and their suppliers of the growth funds they need.
But the Fed has a simple, proven countermeasure for that, right?
They do. If a credit crunch hits, the Fed can just stop quantitative tightening QT, which is them pulling money out of the system. Or, much more powerfully, they can just restart quantitative easing QE.
Printing money.
Essentially, yes.
Yeah.
Printing money and injecting it into the economy. And as soon as QE starts, markets tend to snap right back.
All right, let's move to scenario 3, which I find really interesting because it doesn't even need the Fed to act. It's a market-driven rate rise. We should probably explain the difference between that and a Fed hike.
Yeah, that's important. Think of a Fed hike as them setting the temperature on the thermostat. That's the benchmark rate. A market rate rise, on the other hand, is like everyone in the building turning on their air conditioners at the same time.
Sucking up all the available power.
Sucking up all the available capital in the system. And the 10-year Treasury yield is the best example of this market rate.
So what are these air conditioners that are draining all the capital right now?
Two big things. First, the U.S. government is issuing a massive amount of new debt, new bonds. It's acting like a financial vacuum cleaner, just sucking up available cash.
And second,
The AI giants themselves are issuing huge corporate bonds. Meta just did a big one. So when everyone is competing for the same pool of capital, market rates just get pushed higher, completely independent of what the Fed's benchmark rate is doing.
and that brings us to the biggest systemic threat, scenario 4.
The mandatory Fed hike, the one that's forced by accelerating inflation. This is the danger loop.
The danger loop.
Yeah. If the Fed has to use QE to fight off scenarios 2 and 3, that flood of new money could very easily reignite inflation. And if inflation takes off, the Fed must raise rates. It's their mandate.
And historically, we know the trigger point for that kind of mandatory hike was pretty low.
Yes. The sort of unwritten rule was that the Fed would step in when inflation hit around 3%.
Right.
But the source material suggests political pressure has really changed that.
Right.
Given the resistance to rate hikes from, say, the last administration, the new sort of politically safer trigger point might be much higher now, maybe 4%, maybe even 5%. But if inflation gets that high, the Fed has no choice. They have to act. And that would be catastrophic for this kind of speculative bubble.
Speaking of all this pressure, we saw that sudden burst of volatility in early November. What was the immediate catalyst for that dip?
That was driven purely by Fed Chair Powell's words. He basically warned the market that a December rate cut was not a guarantee at all.
He poured cold water on the idea.
A lot of cold water. And that statement just injected a ton of uncertainty into a market that had gotten really complacent. It created the perfect window for short-term investors with huge gains to just, cash out and take their profits.
So just a temporary reaction.
A temporary reaction to short-term uncertainty. But if you look past that and you consider the political timeline, the long-term base scenario still points toward more money printing.
Eventually.
Eventually. Powell's term ends next May. If a new, maybe more politically loyal Fed chair is appointed, one who's expected to prioritize growth over fighting inflation, well, the underlying market expectation is for a return to easy money, a return to QE.
So the current choppiness is just short-term noise before that political change.
That's the base assumption for long-term investors.
Yeah.
That eventually the taps will be turned back on.
So with these huge forces at play, the duplication, the political pressure, the volatility, what's the sound advice for a listener trying to navigate this?
Look, in times of this kind of deep uncertainty, when timing the market is basically impossible, constantly buying and selling, frequent trading, it's just not the best strategy.
You get chopped up.
You'll get chopped up. The smartest play for the long-term investor is to maintain a stable, sound portfolio that's built to weather these fluctuations and to weather the consolidation phase that we all know is coming.
So we've laid out the two main forces: the structural overinvestment that demands a consolidation, and the financial pressures that will decide when that painful process kicks off.
And here's the final thought we want to leave you with. Forget for a moment about just the Fed's policy rate announcements. You have to watch inflation and you have to watch market rates. Because inflation is this bubble's most dangerous enemy.
Why?
Because the nominal interest rate you see on a bond is the real interest rate plus inflation expectations. So if inflation spikes to 4% or 5%, the market's nominal cost of money goes up automatically.
Regardless of what the Fed says its benchmark rate is.
Exactly. The cost of money will rise all by itself if inflation comes back. So keep your eyes on the market yields and the inflation data. That's the true signal of danger.
Until next time.